This short video is one of a series of short videos that deals with a variety of concepts covered in the chapter on capital budgeting techniques included in the prescribed textbook. The purpose of these short videos is not to replace the textbook or to minimize the learning required to master the contents of this part of the prescribed learning. The purpose of this short video is to use a more visual method to explain and demonstrate how to calculate the net present value that is used in the calculations relating to capital budgeting decisions. Students generally grapple with the application and the calculations when having to calculate the net present value. The contents of this chapter must be studied with focus and comprehension, and many more examples of this concept must be studied and exercises selected and the calculations practiced to ensure a complete understanding of capital budgeting techniques, and in this case, more specifically, the net present value capital budgeting technique.
Dear students, the purpose of this short video is to explain and demonstrate to you how to calculate the net present value of a capital investment. The theory and other relevant information relating to the net present value included in this video, such as the cost of capital, cash flow, and capital budgeting, are comprehensively explained in Chapter 10 of the prescribed textbook. You are expected to fully study and understand these concepts. This video alone is not sufficient learning to cover the entire topic of the net present value. The net present value technique calculates the current value or the present value of a stream of expected future net cash flows flowing from a capital investment. The term net cash flows refers to the net difference between a future cash receipt and a related future cash expenditure. In other words, a net cash flow is the difference between an amount of money received in the future and an amount of money paid out in the future in order to receive the amount of money in the future. Organizations consider capital investments whereby they have to pay significant capital amounts in current day money and then estimate whether the future net cash flows they will receive from such investments expressed in current day money values will be more than the amount invested. In order to sensibly compare the current day or present investment to the future expected cash flows, one needs to express the future net cash flows in terms of their current day or present day values. Organizations are therefore interested to know whether the total amount of all the expected future net cash flows expressed in current day or present day money terms is more than the amount in current or present day money value they need to invest to generate those future cash flows. If it is more than the investment, then the investment is worthwhile considering. If it is less than the investment, then it will result in a loss and the investment is not worth considering. The net present value of an investment can be calculated as follows. As you can see from the slide, the net present value of an investment is found by subtracting the initial investment, in other words, the capital amount that needs to be invested today, from the present value of the cash flows that it will generate, discounted at a rate equal to the firm's cost of capital. So, in other words, if you carefully consider these formulas that are presented to you here, you will notice here that first and foremost the capital investment amount is represented by this part of the formula, CFO. That is the cash flow at time 0. In other words, that's the capital investment amount. And the CFT values are the cash flows that the investment company expects to receive from having invested this capital amount. However, because these are future values, they are future values. In other words, they will only happen in the future. One must express these values in today's money terms, because this amount is in today's money. So in order to compare today's money to today's money, you need to express the future cash flows in today's money. And to do that, you have to reduce or discount it by a certain discount factor, which is in all cases the cost of capital. So in other words, in order to calculate a net present value, you need 3 sets of information. You need the initial investment amount, which means the capital amount. You need the future cash flows, and you need the cost of capital percentage. In some cases, it is also known as the discount rate, or it could also be known as the expected return on the investment. This discount rate that's referred to here is not a discount rate like when you go to a shop and you ask for discount. The discount rate here refers to the cost of capital. In other words, the cost of the sources of finance. So please don't confuse yourself by thinking that this discount rate means the discount that they give you when you purchase something. Furthermore, if you look at the slide, you can see that there are 2 ways that you can calculate the net present value. You can calculate it using a financial calculator, and then the financial calculator will use the format as indicated here. Obviously, if every financial calculator works differently, so you'll have to consult the manual how to do it. On the other hand, if you do not have a financial calculator, then you have to use the interest factor tables, which you will find in Appendix A at the back of the textbook. The tables are also at the back of the study guide, and in the exam, those interest factor tables are attached to the exam paper. Now, if you have to use the interest factor tables, then you need the cash flows. You have to find the interest factors that you have to use in order to calculate the present value. These 2 are the same. And then you need the initial investment. So with all 3 those values, you can then calculate the net present value. There are 2 decision criteria that one can use to decide whether an organization should go ahead and make a capital investment or not. The decision criteria are the following. If the net present value that you calculate is greater than 0, because the net present value is a money value, it is a rand value. If that amount is greater than 0, then the business can accept the project. We say the NPV, the net present value, is positive. That means that if the net present value is greater than 0, it tells you that the future cash flows generated from the investment, expressed in today's money, is more than the amount of money that you must invest today in order to generate those cash flows. So you will be making a surplus by investing in the project. However, if the net present value is less than 0, then the business will reject the project because the net present value is considered to be negative. If the net present value is less than 0, it means that you are making a loss on this investment. The future cash flows that you will get from making the investment will be less than the amount that you have invested in making those future cash flows. When you look at the possible capital investments, you need to distinguish between two types of investment opportunities. In the first instance, we talk about mutually exclusive investment projects. Mutually exclusive means that if an entity is considering two or more investment opportunities, for example, investing in a project A or a project B or a project C, and these opportunities are mutually exclusive, it means that if the entity selects to invest in project A, it cannot invest in B or C as well. Or if it decides to invest in project B, it cannot invest in A or C. In other words, by selecting one project to invest in, the other projects are excluded. That is what mutually excluded mean. In the case of mutually exclusive projects, the entity will usually select the project with the highest positive net present value. On the other hand, one could also deal with independent investment projects. When projects are independent, it means that if an entity is considering investing in two or more investment opportunities, for example, in project A, B, and C, and these opportunities are independent, it means that the entity can select A and it does not exclude investing in B and C. So in other words, the entity can select investing in project A and B and C. They do not exclude each other. In a scenario like this, the entity will, however, only select the projects with positive net present values. It's important that you make the distinction. When you look at an exam question or an assignment question or any other scenario, make sure that you know whether the projects considered are mutually exclusive or whether they are independent. Here we have an example of a net present value investment. We have here a company who is currently considering investing in a project. The project requires an initial investment. This is very important. An initial investment of 420,000. That means if the company wants to invest in this project, it will have to invest an amount of 420,000 rand. This is also the amount that it will have to invest at the start of the project. The relevant operating cash flows from the project is represented in the table below, as you can see here. And the cost of capital, which I referred to just now, for the company is 12%. Now, as I've mentioned in a previous slide, sometimes in some instances, textbook talks about the discount rate, or it can also say the expected return. So when you deal with net present value calculations, cost of capital, discount rate, or expected return means the same thing, and it is a percentage value. What does this example tell us? It tells us that if this company invests this 420,000 rand, it expects that in the next 5 years, in every year, it will receive a net cash flow money coming in after expenses have been subtracted of these amounts. These are the net cash flows that the company expects they will earn by investing this amount. Now, these are future values, as I've explained to you. They will happen sometime in the future. And this is a present day value. In other words, what now has to be done is these future values must be expressed in present values, present day values, so that you can compare those two, present day with present day. Now, in order to do that, we need to use the discount rate or the cost of capital to recalculate the present values of these future cash inflows. How is that done? Well, the first thing that you need to do is to find the present value interest factors for 12% cost of capital. And this you will find in Appendix A at the back of your textbook, or you will find the tables at the back of the study guide. And the table that you need to look for is table A2, which is a present value interest factor table. The cost of capital percentage that we are working with is 12%. So you need to find the 12% at the top of the table, and you need the present value factors for the first 5 years, because in that table we had cash flows for 5 years. Now, for 5 years, for 12% cost of capital, these are the factors that you are going to use. These are the factors that will convert those future cash flows into present value cash flows. How is that done? It is done in the following way. There we have the table. These were the original cash flows that we had in the original table. Those were the expected net cash flows for the 5 years. These are the factors that we found in the interest factor tables. And all you now need to do to get the present values is to multiply each cash value by its factor. And you have the resultant present value. So what it tells us here, how do you interpret this? It tells us that 140,000 Rand 1 year from today, discounted at 12%, is equal to 125,020 Rand today. That is 1 year from today. This is today. So you can see that the future value is more than the present value. And that's the case in all of these scenarios. What you then need to do is you need to add them up to get the total amount. The total value of these future cash flows in today's money is 462,090 Rand. Right. How much did you have to invest in this project? If you recall from the previous slide, the initial investment was 420,000. So the 420,000 represents the initial investment. We now subtract the initial investment from the total present value of these cash flows, and we see that the difference is positive. So it's a positive amount, and this 42,090 Rand is the net present value. Net means the difference between these two values, and it's in present value terms. So in terms of a decision, we will note that the net present value is greater than 0. It's positive, and therefore the project can be accepted. So here you have an example that demonstrates to you exactly how to calculate the net present value for an investment in one project. Now, if there are 2 or 3 projects that the entity could invest in, irrespective of whether they're mutually exclusive or independent, you will have to calculate the net present values for each investment in exactly the same way, and then compare the net present values. In the case of mutually exclusive projects, you will then select the project that has the highest net present value to invest in, because mutually exclusive means if you select one, you can't select the other. However, if they are independent projects, then you can invest in all of them at the same time, and then you will select those projects where the net present values are positive. If the net present value is negative, it means that the initial investment amount is bigger than the total net present value amount, and then you will not invest in such a project. So make sure that you understand how to apply this technique. It's very important that you understand how to use the interest factor tables correctly, and then you will be able to calculate the net present value. All you then have to do is apply the decision criteria.